delighted and honored to give this this talk. We have been talking about it for some time, and I'm very happy to see it materialized. In this paper, what we're trying to understand is how distributional considerations of idiosyncratic shocks, inequality, and so on, may affect the design of monetary and exchange rate policy in the open economy. So why do you think it's an important question? Well, small open economies, and Israel is one, are regularly hit by shocks originating from abroad. And those shocks have the usual effects on aggregate that have been relatively well studied in the literature, but usually they also affect distributions, the distribution of income, and possibly the distribution of wealth, and ultimately the distribution of consumption. And this is something that welfare concerned policymakers should care about. So that's one reason. The other reason, even if you think that external shocks may not be so important, there are international spillovers, exchange rate adjustments modify. There is an external channel of aggregate demand. So movements in the exchange rates will affect the internal equilibrium, will affect inflation domestically, the output gap, and so on. Okay. And by way of consequence, they will also affect the distribution of earnings, the distribution of wealth, and the distribution of consumptions. So these, in a sense, these are all policy questions. The fact that external shocks or the propagation of domestic shocks affect inequalities. But this interest has been rejuvenated by a recent trend of the literature that has essentially extended the HANK framework to open economic questions. Okay, so the literature was, I think, kickstarted by a paper by Defera, Mittman, and Romay, who look at the contractionary effect of devaluations when countries borrow in foreign debt. Okay, and these devaluations will affect the distribution of wealth of domestic agents, pushing those who have low wealth to cut on spending and possibly triggering a contractionary new Keynesian cross. Okay. So that's I think the first paper that had really incorporated this dimension of heterogeneity. And it was shortly followed by a paper by Auclair et al. And that essentially looks at something related and perhaps even more general, which is the real income channel. In the open economy, national income is very sensitive to the real exchange rate because the latter is related to the relative price of home-produced goods, and this affects national income, and therefore fluctuations in national income is going to affect the consumption behavior of those who are liquidity constrained, of those hand-to-mouth people. And again, shock to national income coming from the exchange rate might propagate aggregate shocks in this way. So distributions matter, according to that literature, for the propagation of aggregate shocks. Okay, and thus far, so there has been some follow-up papers looking at other shocks, trade shocks, capital flow shocks, under various assumptions about financial integration, trade integrations, and so on. What this literature has been mostly interested in are the positive effect of aggregate shocks. Okay, and what we're doing in this paper, we aim to provide a normative benchmark. What is it that the central bank should do? Not only what it does and how it affects the response to macro shock, but what it should do in response to those shocks when those external or domestic shocks affect the distribution of income. Okay. So let me summarize in a nutshell the spectrum of questions that we are interested in and how we're going to frame it in within our model. What we have in mind is that aggregate shocks, be there, as I said, external shocks, so capital flow shocks, trade shocks, or domestic shocks, think of domestic productivity shocks, are going to affect output, just as in the closed economy, but it's going to also affect national income because it affects not only output, those shocks, but they also affect the relative price of home-produced goods, the real exchange rate, and therefore how output is multiplied by this domestic prices, the relative price of home-produced goods. All those fluctuations in output and national income will translate in an economy that has incomplete markets, and heterogeneity will translate into fluctuations in consumption risk and inequalities. Okay, and those fluctuations in general will be inefficient from the point of view of the domestic planner. This creates potentially a new term in the trade-offs that the central bank faces. Okay, the central bank, to the extent that the other policymakers are not fully dealing with these inefficient fluctuations in risk and inequality, the central bank will have to play its part, and stabilizing consumption inequality may conflict with the traditional objectives that the central bank has and that the traditional open economy literature has studied extensively. So just to provide a brief summary of what the standard new Keynesian model says, well, if you think of the closed economy representative agent new Keynesian model, we know that there can be a tension, a conflict, a dilemma, a trade-off between closing the output gap and stabilizing inflation. When you open the economy to trade and international trade and international capital flows, there might be a new motive showing up, which is the manipulation of the terms of trade. So typically, policymakers, domestic policymakers, affect by their macroeconomic policy, they're going to affect the aggregate supply of home-produced goods. So they exert some sort of monopoly power on this supply, and they may want to play on it on average, and also in response to aggregate shocks. So, for example, that may justify why when there is a shock that causes an appreciation of the currency that is harmful for exporters, then the central bank may want to provide more accommodation than it would in the closed economy to limit the extent of the appreciation, even if there is a cost in terms of domestic inflation. Okay, so this is what the traditional literature has been looking at. So there is already a trilemma in open economy models, and we're showing that there is potentially a quadrilemma to the extent that the central bank also cares about stabilizing inefficient fluctuations in consumption inequality. The analysis is quite intricate, as most optimal policy exercises are. So we're proceeding gradually, and because there are several motives interacting, the natural way of proceeding is to look at a nice benchmark where we understand exactly what's going on. Okay, and this is what underlies the search for divine coincidence results, situations where the various objectives of the central bank do not conflict. And then once we understand when they do not conflict, we can better understand the circumstances under which there are trade-offs and conflicts between objectives. So we're going to do exactly that. We're going to start by eliciting a parameter set, a configuration where there is what we call the SOE, small open economy HANK divine coincidence, where all four objectives that I've just mentioned on these slides are perfectly aligned. Okay, so it's going to be, if you wish, a generalization to heterogeneous agent economy of the traditional small open economy divine coincidence that has been derived inter alia by Gali and Monacelli some 20 years ago for the rank model. But we're going to show that the calibration that leads to the SOE-HANK divine coincidence is unrealistic. And if you impose a more plausible calibration, especially as regards the trade elasticities and the cyclicality of the income risk that households face domestically, then the optimal policy will call for more output and exchange rate stabilization than in rank. Okay, so essentially there's going to be shocks, and we're going to consider capital flow shocks and domestic productivity shocks. And in response to those shocks, the central bank will want, under plausible elasticities, will want to stabilize the exchange rate at the cost of the domestic objectives, inflation and output gap stabilization. So it rationalizes what is sometimes called the fear of floating, the fact that it seems that small open economies care more about stabilizing the exchange rate than the basic rank model suggests. Well, we have a theory for that. Okay, so let me describe the model. I'm going to only provide a sketch of it. If I have questions, I'm going to zoom in with some details, but otherwise everything is available in all the calculations are in the appendix to the paper. I want to convey the main message here. So we're working with the standard small open economy framework of Gali and Monacelli, to which we add incomplete markets. Okay, so that frameworks represent a small open economies as a point in a continuum of small open economies. Okay, so the small economy takes world aggregates as given, has no impact on aggregates, so it kills many of the spillovers that two-country models have, but still there is a lot that you can say within this framework. And we are altering this framework to introduce imperfect insurance against idiosyncratic and aggregate shocks. In terms of how we model the households, we're going to have a perpetual youth structure with a turnover rate 1 minus var theta. So that's the share of the population that exits the economy and also enters the economy, so that the population is stationary. And we introduce this structure so that we're making sure that that there is a stationary distribution of wealth. Okay, otherwise, if people live forever, it might be that the wealth of some people drift away so much that there is no stationary distribution. And we're going to combine two sources of heterogeneity. There's going to be ex ante and ex post heterogeneity in the model. So let me start with ex ante heterogeneity. We're going to have a group. Ex ante heterogeneity is about access to asset markets. Okay, so there's going to be a group of unconstrained households who can freely participate in asset markets. And they can trade one period real actuarial bonds that are going to be non-state contingent. Okay, so they deliver 1 unit of the domestic consumption basket in the next period upon survival. Okay, and the other part of the population in share theta will not have access to any bonds, either for borrowing or for savings. They're going to be hand to mouth. Okay, they do not access asset markets. And this ex ante heterogeneity will capture many of the propagation channels that the HANK literature has emphasized, that the fact that people who are close or at their borrowing constraints have a consumption response to their income that's going to be they have high MPC. Okay, so here our hand to mouth people have an MPC of 1. And the aggregate MPC is going to be the cross-sectional average of the MPC of the unconstrained and the constrained households. So that's one source of heterogeneity, ex ante. The other source of heterogeneity will be ex post. We're working with a Bewley-like model where people are both unconstrained and hand-to-mouth households are repeatedly hit by idiosyncratic shocks that are uninsured. Okay, so they are hit by idiosyncratic shocks and also by aggregate shocks that are going to be moving the aggregate states. Okay, so it's a complicated model in all generality, very hard to solve. I suspect that in all generality it's not going to be you would not be able to solve it even with the most advanced numerical methods, given the number of state variables that we have. So we leverage on some work that we've done before for the closed economy, where we solve a similar problem imposing the Cara normal structure. Okay, so households have constant absolute risk aversion utility with respect to consumption, and idiosyncratic risk is normally distributed. So of course, these are restrictive assumptions, and hopefully the message that these assumptions allow to derive and convey, hopefully you'll be convinced that they would hold more generally, but I cannot establish that formally. So I'm going to spend some time describing what happens on the side of the household, because this is where much of the action takes place relative to the traditional literature, and I'm going to be quicker on the supply side and capital flows and so on, where we mostly import what the literature has traditionally been doing. Essentially, so if we start with unconstrained household, those households can freely borrow and lend against each other. What the current normal structure gives you are linear policy rules. So there is a suitably defined individual state. Think of cash on hands, which results from your current income plus your beginning of period assets. And your decisions will be linear in that state. Okay, your consumption decision and your asset or holding decisions will be linear in that state, which means that you can linearly aggregate the behavior of the household. So despite the fact that people have been hit by many idiosyncratic shocks, that there is potentially very large cross-sectional, infinite dimensional cross-sectional heterogeneity, the linearity in the policy rules allow for aggregating the behavior of the households. When you do that, you can show that you can summarize the demand for this group of households by a Euler equation that describes the behavior of the group as a whole. Okay, and this is what the first equation on this slide is showing you. So CT of U is the total consumption of the group of unconstrained households, and consumption growth going forward is a function of the real interest rate via intertemporal substitution, and it's also a function of their precautionary savings. So there is a precautionary savings here terms because people face idiosyncratic risk and therefore consumption fluctuations in the next period, and their precautionary save depending on the extent of this consumption risk. Okay, so greater consumption risk implies a steeper consumption profile from today to tomorrow. Okay, and what is consumption risk depending on? It's a forward recursion, but in simple words, it's going to depend on income risk. Sigma y here. So in fact, it's the entire sequence of sigma y, because people are forward-looking, so they just do not look at the current income risk or earnings risk, but at the path of earnings risk going forward. So earning risk, the sequence of earnings risk sigma yt is affecting consumption risk, and earnings risk is affected by output. Okay, so this is the very last equation on the slides. It ties the earnings risk that households face to the business cycle, to the deviation of output from the mean. Okay, so this is built into the model. It tells you how a given level of income is spread across the households. It tells you that when you're in a recession, so y hat is low, if the parameter phi is positive, then there's going to be greater earnings risk, which is what is empirically plausible, right? That there is greater earnings risk in a recession. So there are models that endogenize this counter-cyclicality, such and matching models do, for example. Here, because of the current normal structure, we cannot have an explicit such and matching model, but this is capturing the counter-cyclicality of risk. If phi is equal to 0, risk is acyclical, and if phi were negative, we would have pro-cyclical risk, greater risk in a boom. Okay? All right, so that's for the unconstrained households. Now, if you look at the hand-to-mouth household, the other group that I was mentioning, life is harder for them because they cannot use borrowing and lending to insulate their consumption from the shock. So if you average the consumption, so they are also hit by idiosyncratic risk, okay? But for this group, on average, this idiosyncratic risk is washing out. So CT of H, which is the mean consumption of these hand-to-mouth people, is just national income. They consume their fair share of national income, okay? And that is if you consolidate their budget constraint, taking into account the fact that they cannot borrow or lend. And here, the subtlety relative to the closed economy model is that national income is not just output. It's output multiplied by the relative price of home-produced goods, the real price of home-produced goods. So big P of HT is the nominal price in domestic currency of the home-produced goods, and PT is the price of the consumption basket of domestic consumers. And this is, you have to multiply YT by PH over P to get national income. So this relative price, this real price of home goods, of home-produced goods, is directly related to the real exchange rate, directly related to the terms of trade, to the real exchange rate. There is, all these terms have a bijective relation between themselves. Okay, so saying that the domestic consumption basket appreciates, so the real exchange rate Q falls, is the same thing as saying the relative price of home-produced goods increases. Okay, it's the same thing as saying the terms of trades are improving, right? So we're going to call this relative price of home-produced goods small ph, and it's going to be a function of Q, the real exchange rate. This is important because this is what the literature has stressed to be, and it's called the real income channel. Okay, so it plays a prominent role in the work of Auclair et al. The real income channel, and it's going to be playing an important role in our analysis, is the fact that fluctuations in the exchange rate, in the real exchange rate, if not fully stabilized, are going to trigger fluctuations in national income that are going to directly hit the consumption of hand-to-mouth households. Hand-to-mouth people are really responsive to change in the real exchange rate via this channel. So if you want to stabilize the consumption of hand-to-mouth people, you're going to have to stabilize the real exchange rate. Okay, and that's pretty much all for the behavior of the consumers. Of course, it's an international macro model, so there is a demand system associated with the consumptions of both groups. It's going to be spread between home-produced and foreign-produced goods, depending on trade elasticities. Okay, so we have a demand system à la Gali Monacelli, where eta is the elasticity between home-produced and foreign-produced goods. Okay, so how much do I respond? Is measure the extent of expenditure switching, if you want. How much do I respond to changes in the relative price of foreign versus home-produced goods? There is a parameter nu that tells you how much goods are substitutable across countries. So that's going to affect your elasticity of exports, how much the rest of the world is going to be responding to changes in the relative price of the goods you sell. Okay? And then there is the usual epsilon, which is the cross-partial elasticity of between individual varieties. Okay? We're going to have a utilitarian union that sets wages and demand uniform labor from the households. That's to simplify the analysis. To be as close as possible to the Gali Monacelli framework that we are essentially extending to the heterogeneous agent case, we're going to still assume flexible wages and sticky prices. Okay, you could carry out the analysis under the alternative assumption, but that would take us further away from Gali Monacelli and make the comparison less straightforward. So the rest of the model is as follows. We have a new Keynesian Phillips curve for home-produced goods. So it's a new Keynesian Phillips curve for the producer price index. That features the future price and the current real marginal cost. And the real marginal cost also features the relative price of home-produced goods. We have that was the first equation. The second equation is a market clearing condition for home-produced goods. So on the left, you have total domestic output net of the cost of inflation. I should have said that we have Rothenberg pricing here, so quadratic cost of price changes. So if you move from zero inflation, so if you move away from big pi H is the inflation factor of the PPI, producer price index. If it's 1, then this cost is 0. But if you depart from 1, either upwards or downwards, there is a positive cost of inflation that's going to reduce net output. Okay, N is total labor input, and Z is labor productivity, and you divide by this cost of inflation. So that's output, and on the right-hand side of this equation, you have the demand for home-produced goods, and this demand comes from domestic consumers and from foreign consumers, both of which depend on the overall consumption of these two groups of people, CT and C star, and the real exchange rate. Okay, the real exchange rate generates expenditure switching both for domestic consumers and foreign consumers. We have, as I said earlier, in passing, and you may not have noticed, but it's important in the analysis, we have incomplete markets with respect to aggregate shock. And importantly, we have imperfect international risk sharing. Okay, that means that home savings, there's going to be capital flows following aggregate shocks in general. Okay, the domestic economy is going to accumulate assets towards the rest of the world, or they accumulate assets in response to shocks. And this net foreign asset position is big 80 here. And because, as I said, we have some population turnovers, we have actuarial bonds, the parameters theta, and so the small 80 is the quantity of actuarial bonds that are issued by domestic intermediaries. And then you have to multiply by some parameter because only the unconstrained people hold those bonds and so on. But what you really care about is the big 80, which is the net foreign asset position of the economy. And the equation tells you that net foreign assets vary as a function of the difference between national income, PHY, and domestic consumption, total domestic consumption, CT. And the last equation is the real interest rate parity that tells you how the growth in the real exchange rate is related to the differential in real interest rate between the rest of the world, R star, and the domestic real interest rate R. Okay, and we have a term in this real, we have interest rate elastic foreign debt. This means that there is a small cost from departing to net zero to the zero NFA. So if you're lending to the rest of the world, the more you lend, the more intermediation costs kick in, and the lower your return on those assets as a domestic economy. And conversely, if you borrow, the more you borrow, the greater the cost of this borrowing. So this is captured by this last term in the really interest rate parity. It can be as small as you wish, but it's needed for a steady state with to exist where the net foreign asset position asymptotically goes back to zero. Okay. And for us, because of that reason, it also matters for the existence of a Ramsey plan when we look at the optimal monetary policy. Okay, so how would
Edouard?
you, yeah,
Yeah,
shoot?
I just have one question about
Sure.
the construction of the model. So my question is more related to the risk aversion. So in my opinion, what you model is that we have the same risk aversion for hand-to-mouth and constrained households. And as far as I understood, also for the foreign economy, we have the same risk aversion, correct?
Yeah.
So I would expect to have different risk aversion, at least between the two agents, but also between two countries. So maybe
I mean,
if you assume,
we could. I think we could easily introduce this feature. You have to keep in mind that hand-to-mouth people. So risk aversion, it's the coefficient of risk aversion, and given our specification, is the same thing as the coefficient of prudence. How much people are willing to precautionary save in response to risk. But you have to keep in mind that hand-to-mouth people can't do anything about it. So for them, the gamma, the coefficient of risk aversion, is going to affect their utility from the idiosyncratic fluctuations that they are facing. But it's not that they can adjust the savings in response to that. So if you change their risk aversion coefficient, you will change their welfare, okay,
Mhm,
relative to what I have. But you're not going to change their behavior because risk aversion is immaterial for their behavior.
mhm,
They
mhm,
cannot borrow and save.
mhm.
Okay.
Okay.
But
And
yeah, this
also,
is something that we could consider, and also asymmetric. I mean, again, it's the challenge in this paper and much of this literature is to there are many ingredients, so that somehow you need to cut the complexity at some point. But these are
sure.
certainly things that we could consider.
Okay, thank you.
Okay, so now, optimal policy, going back to the question that I was discussing at the beginning, and I hinted at the fact that in the traditional literature, what the traditional literature is about is how much should you care about stabilizing your exchange rate relative to caring about your internal objectives. Okay, and much of the literature has been about deriving conditions where to follow, there is a nice statement by Milton Friedman on that. We basically suggesting that you should disregard the exchange rates. Well, what the new and the modern analysis tells you is that, yeah, there are some conditions in which you may disregard the volatility of the exchange rate. Whatever you do domestically will bring about the right volatility of the exchange rate, the volatility of the exchange rate that you exactly want. Unfortunately, it's not always the case. And if it's not the case, then there is a conflict of objective between the internal and the external objective. Okay, so the traditional open economy literature, when it comes to optimal policy, has entirely been about that. Okay, and we want to revisit these questions by considering the role that inequalities play in the picture. How does it change the trade-off that the central bank faces and this conflict between internal and external objectives? So, as you may have guessed, introducing agent heterogeneity it's always a challenge for optimal policy, but it's even more of a challenge in open economy models because we have more state variables. Just to give you an idea of how complicated the general problem would be and why we simplify it. So this would be the social welfare function of a planner here, the central bank, that would be utilitarian, give equal welfare weight to everyone, and maximize this aggregate utility, this sum of utility. Okay, and the beta comes from the fact that the planner is discounting a flow of total utilities across future periods. But in these flows, you have lots of different people. You have people belonging to different cohorts because we have a Blanchard-Chiari demographic structure. So that's the summation term, the discrete summation term in this expression. And within cohort, they are heterogeneous because they have been hit by different idiosyncratic shocks. This is the integral, the continuous summation term in this expression. So that makes the problem inherently complicated, but here again, the Cara-normal assumption will come handy and allow us to drastically simplify the problem. In fact, what we show in our closed economy paper, and again in this paper, is that there is a separation that you can bring about. You can play using the Cara-normal assumption. You can reduce the social welfare function that I showed before to this one, where U of C is the notional felicity, the felicity or utility of consumption of a notional representative agent, what the average agent would enjoy. And there is a correction, this big sigma term, that captures the welfare cost of inequalities. Okay, so you can separate the welfare losses, so to say, that are coming from aggregates not behaving as you would want, and the welfare losses coming from the dispersion of consumption around the average level of consumption. In the rank model, the representative agent model, trivially, big sigma is equal to 1, because there is only a notional there is a representative agent there. Okay? In HANK, big sigma is going to be hovering above 1. Remember that we have a Cara utility function, so U of C is negative. So a higher value of big sigma is going to reduce social welfare, this big W 0. Okay? And aggregate shocks are going to affect this value of big sigma. And that the planner will worry about that because this is the cost of inequalities. Now, as you remember, we have two sources of heterogeneity, ex ante between unconstrained and hand-to-mouth, and ex post due to idiosyncratic shock. So this big inequality index or cost of inequality index, big sigma, is going to be, you can break it down into different terms. Some terms that capture inequality within groups, so within the group of unconstrained and within the group of constrained households. That's going to be the big sigma U and the big sigma H. Big sigma U is the inequality within the group of unconstrained households due to idiosyncratic shocks. Big sigma H is the inequality within the group of hand-to-mouth households. And gamma is going to be an index of between group inequalities. So the overall inequality index, big sigma, combines between and within group inequalities. Okay? What the Cara-normal assumption gives you is a tractable expression for sigma U, first of all. Okay, so this inequality index is going to evolve according to a quasi-AR1 process. It's a scalar that you can keep track of. Okay? And we also have a tractable expression for the cost of inequality within the group of unconstrained of hand-to-mouth households, which is given there. Okay? And the epsilon t is simply the difference in the mean consumption between the unconstrained and the constrained. Okay? So anytime one of those inequality indexes increases, then big sigma is going to increase. So this is tracing back this overall inequality index to its sources. It's going to be important when interpreting the impulse responses. Just a word without going into the details about fiscal policy. Anytime that you formulate an optimal monetary policy, and I'm also saying this for PhD students, if they are in the audience, you should always ask yourself whether you're not giving too much of a task to monetary policy because you're giving so little power to the fiscal authority. And it's a question that you should be naturally asking yourself when thinking about inequalities. We usually typically think of inequalities at least partly to be dealt with by fiscal policy. So in the paper, we are careful in taking these considerations seriously. And there is a division of tasks between fiscal and monetary policy. Okay, so there is a whole set of fiscal tools. In fact, a fairly complete set of fiscal tools, but we restrict the fiscal tools in a plausible ways. Okay. In particular, much of the fiscal tools are going to be time invariant. Okay. This captures the fact that fiscal policy is typically inertial. Okay. Whereas monetary policy is quite flexible. Second, we're going to have proportional taxation, therefore distortionary taxation. So maybe you want to raise taxes to fix one wedge, but if you raise taxes too much, you're going to destroy other aspects of the economy. Okay, so each of those tax rates are set optimally, but the steady state that results from these optimally set taxes is a constrained efficient steady state, not a first best efficient steady state. Okay, so it's going to be a steady state that optimally balances various wedges. It's going to be a steady state when there is some inequalities, because completely eliminating inequalities would generate too much tax distortions. And we're going to ask, start from this constrained efficient steady state. Suppose there is an aggregate shock that perturbs the economy, a trade shock, capital flow shock, productivity shock, you name it. It's going to perturb this balance. How is monetary policy going to respond? In particular, inequality, which were at their constrained efficient level prior to the shock, will move away. Maybe it's the case that the shock reduces inequalities, but maybe it's the case that the shock increases inequalities, and then monetary policy has a role to play because fiscal policy is too inertial to respond. Okay, that's the way we think about the problem. So let me start by looking at domestic productivity shock. The reason I'm looking at those shocks is because this is the type of shock that leads to divine coincidence in the closed economy model, and that has also extensively been studied in the open economy model to see where the small open economy divine coincidence holds. Okay, and this is the shock that Gali and Monacelli are using in their analysis of the small open economy coincidence, divine coincidence. So if you take their representative agent benchmark, what they show is that if you have the so-called Kohlheitsfeld elasticities, so unit elasticity of intertemporal substitution, and the elasticities between foreign and home-produced goods in the consumption basket and across countries in the consumption basket. So if all these elasticities are equal to 1, the Kohlheitsfeld elasticities, then domestic producer price stability is optimal. Okay? And the literature calls this an inward-looking monetary policy. What is this saying is that, of course, it's a small open, we're talking about the small open economy. So the exchange rate is moving around, terms of trade are moving around, and they are generating expenditure switching, affecting the trade balance and so on. But under those conditions, if you just focus on stabilizing domestic producer prices, then you bring about exactly the correct amount, the correct quantity of volatility of the exchange rate. The exchange rate is exactly as volatile as you want it to be. So it buffers the external shocks exactly in the right way for you. So you shouldn't care about it. You should just care about the domestic objectives. Okay, so this is what Gali and Monacelli have shown. They have shown it in the context of a model with full international risk sharing, but it's also the same is true under imperfect international risk sharing, provided that there is a representative agent in the domestic economy. Okay. One important property of this allocation, of the optimal allocation that is brought about by price stability, is that domestic agents exactly consume national income. So there is no capital flows under Kohlheitsfeld elasticities and the optimal monetary policy. Okay, so stable prices, no capital flows, people consume, the representative agent consume their national income. Okay, so this is the impulse responses that you would see in the rank model after a negative domestic productivity shock, ZT. So basically, it's a contraction in aggregate supply. So the central bank responds by contracting aggregate demand so that there is no inflationary pressure. So the real interest rate goes up. And the real exchange rate falls. So there is a real appreciation of the domestic consumption basket. Output falls because it's a recession. But prices are stable, consumption falls, and AT, net foreign assets, stay stable. Okay, so this is exactly what is the optimal policy in the rank model under Kolob's-Feld elasticities. And as you probably guessed, it exactly reproduces the flexible price allocation, which is the efficient allocation in this scenario. Okay. So this is the so-called open economy divine coincidence in rank. Now, we generalize this result to HANK under some conditions. That's going to be the benchmark that we're going to be departing from afterwards. But first, we want a benchmark that we fully understand. And our benchmark is as follows. Suppose you keep the Kolob's-Feld elasticities. And in addition, you assume that there is risk, there is idiosyncratic risk. So we're not in the rank world, but risk is acyclical, is unresponsive to the business cycle. There is just as much earnings risk in a recession that there is in a boom. Then you implement exactly the same monetary policy optimally than in the rank benchmark. There is no difference in optimal policy. There is still divine coincidence, despite the fact that people are heterogeneous. Okay? And the intuition, I think, is quite straightforward. If risk is acyclical, there is nothing you can do about it by manipulating output. Okay, so there is risk. It is costly to the planner, but risk is independent of output. It's acyclical. So whatever you do is not going to, as a central bank, is not going to affect anyhow the quantity of idiosyncratic risk that the agents face. If it does not affect it, then the central bank should disregard it altogether and focus on the other objectives. Okay? Now that's what acyclical risk brings you. Kolob's-Feld elasticities tell you, and you may remember the previous slides, that in the rank model of Gali and Monacelli, people do not save. So people, despite the fact that they are all unconstrained, they do not save or borrow towards the rest of the world. They consume exactly national income. But in an economy with hand-to-mouth and unconstrained households, that means that unconstrained households consume exactly the same as hand-to-mouth people, except that they are not constrained to do it. They choose to consume national income. So in that configuration, there is no between-group inequalities. Okay? So under the conditions of the proposition, there is neither within-group inequalities that the central bank could affect or between-group inequalities that the central bank could affect. All right? In that case, the SOE-HANK divine coincidence falls. Now, and this is the same, this is a graphical illustration. This is exactly the same IRFs, except that the blue line is HANK, the red line is rank. They are exactly on top of each other. Okay? Now, this is a benchmark, right? It relies on elasticities of trade and of intertemporal substitution, and on a cyclicality of risk that are not realistic. So we're going to explore, now that we understand what happens in this benchmark, we want to see what happens in more realistic scenarios. And our more realistic scenario will involve countercyclical risk rather than acyclical risk. And we discuss in our closed economy paper how to calibrate the cyclicality of risk, drawing on the evidence that there is on this cyclicality. And we impose the same parameter here, which is phi is equal to 5. And if you remember how sigma y, the conditional standard deviation of earnings depending on the business cycle. That implies that when we are in a recession, output falls, then earnings risk increases. People face greater risk. And therefore, there's going to be more inequalities in earnings, more inequalities in consumption. And that's going to be costly. So that's one aspect. The other aspect will be to change the elasticities towards more realistic values than the collapse-fed elasticities. Okay, so here there are different ways of calibrating the model. Here we just pick a set of elasticities from a recent paper by Egorov and Mukin that captures the fact that trade elasticities are relatively higher than collapse-fed, and the elasticity of intertemporal substitution is smaller than collapse-fed. Okay, so risk aversion equivalently is greater. So here it's going to be gamma equal to 2 for the risk aversion coefficient, and the trade elasticities eta and nu are higher. Now let's see what happens. So we're going to introduce these features one by one, so to really understand what we're doing. So this is the response to a domestic aggregate productivity shock. When we keep the collapse-fed assumption, but we assume that risk is counter-cyclical rather than acyclical. And now, so the dashed red line is the rank optimal policy. Obviously, because there is no risk in rank, it's the same as the red line of before. And the blue line is the optimal policy in HANK. So what do you do now? Well, you implement less exchange rate volatility, that's panel C, and less output volatility, that's panel D, than in rank. Okay? And it's quite natural. Here, idiosyncratic risk is counter-cyclical. So for example, if you let following a contractionary productivity shock, if you let the domestic consumption basket appreciate as much as in rank, then that would trigger a lot of expenditure switching, a large fall in output, and therefore a large increase in inequality, in risk and in inequality. And you want to stabilize that. Now you can stabilize that, okay? Because risk is not acyclical. So manipulating output is also manipulating risk. All right, so that's the blue line. You stabilize the exchange rate, you stabilize output, you're more accommodative in response to this shock. So you can see that the real interest rate in panel B increases less in the blue line. And the cost is inflation. Okay, it's the typical situation where there is a trade-off. You can't have it both ways. If you have less of a recession, you're going to have more of inflation, and that's the blue line in panel E. Okay. Now you could ask yourself, what would happen if you're in HANK, but you think you're in rank, and you implement the optimal policy in rank, that is the policy of price stability, whereas you're in HANK. So that's the black line. Okay, in the black line, you stabilize prices, look at panel E, but then there would be more of a recession than in the blue line, and a stronger appreciation of the domestic currency. Okay, so this is what idiosyncratic risk brings to optimal policy relative to the rank benchmark. Now bring the other feature into the picture. The other feature was the fact that trade elasticities were higher than in the collapse-fed case, and also the elasticity of intertemporal substitution was lower. Now, what happens are two things. First, things that we already know is that the terms of trade manipulation motive kicks in. You remember that I told you at the beginning there is potentially a quadrilemma. There is output gap stabilization, there is inflation, domestic inflation stabilization, there is terms of trade stabilization, the terms of trade manipulation, and there is inequality management. Now, if I move away from collapse-fed elasticity, the terms of trade manipulation kicks in. It might be optimal for me to pay attention to the exchange rate, even in rank. Okay, so typically, so if you see a negative productivity shock, so look at the dashed red line. You don't, following this shock relative to the previous case where we had collapse-fed elasticities, even in rank, you do not want the exchange rate to appreciate the domestic currency or the domestic consumption basket to appreciate so much. Because if trade elasticities are high, that generates a lot of expenditure switching and output would contract too much. So what you want to do is prevent this excess, be more accommodative so that the domestic currency does not appreciate too much. So the dashed red line here is falling less than the previous dashed red line. But you do even more stabilization in HANK, that's the blue line. Because not only do you have the terms of trade manipulation, you also have the stabilization of inequality motive that kicks in. Okay, and here what is playing a role here is both when you move away from Collapsfeld, both sources of inequality will play a role. Okay, it's no longer the case that the consumption of hand-to-mouth and unconstrained household on average are the same. So there's going to be more between group inequalities. And it's also the case that because the shock is generating a contraction, it's going to increase risk. So both motives are pushing you to stabilize the exchange rate even more than in rank, where it's already the case that the terms of trade manipulation motive kicks in. So really, you really fear floating in that situation. You really want a smooth exchange rate. So you respond aggressively in the sense that you let inflation go. You can see the blue line here in panel E again. You let inflation go quite a bit to make sure that there is not too much of a contraction in output. I think I have 1 minute left, so I'm gonna just mention what happens after a capital flow shock. Capital flow shock, just to cut a long story short, it's more of the same. A capital flow shock here, what we are modeling is a capital inflow because there is a fall in the world interest rate, R star, and therefore there is a sudden appreciation of the currency. Okay. And so here again, you want to stabilize the exchange rate more than you would do in rank. And also in rank, you would stabilize it more than you would do in rank under collapse. Okay, so again, the terms of trade manipulation motives and the inequality stabilization motive are playing in the same direction. And the reason is that capital flows are shocks to the real exchange rate. So they are almost direct shock to national income. Okay, and if the trade elasticities are relatively high, then there is a lot of expenditure switching resulting from this shock. So following a capital inflow, it's true that the real price of home goods appreciates, but people are moving away from home produced goods so much that national income collapses. And if national income collapses, then the consumption of hand-to-mouth people collapses. Okay, that's the real income channel of Auclair et al. And you want to mitigate the extent of this real income channel. Okay. So just to wrap up, I first showed you a benchmark scenario, which is essentially shows you the condition under which the divine coincidence generalizes to the HANK model. Whether we are in a closed or an open economy, it doesn't matter. It's a set of conditions that make this inward-looking policy optimal. If you move away from those conditions and towards more realistic assumptions for the trade elasticities and the cyclicality of risk, then you see that the small open economy wants to stabilize the exchange rates, potentially at the cost of the domestic objective. So it is willing to let inflation go or deflation in order to get more exchange rate stabilization. And what matters here and I'm going to conclude on that, is that there was this literature that emphasized the role of Kolopsfeld elasticities for terms of trade manipulation. It's when you move away from Kolopsfeld, then you want to stabilize the exchange rate more because you want to manipulate the terms of trade. And we show that it also matters greatly for inequality because it's going to generate those between group inequalities and activate a strong real income channel. I'm going to stop here. Please feel free to ask questions.
Yeah, thank you very much, Edouard. It was very, very interesting paper and presentation. So I have a couple of questions. So for the audience, feel free to raise your hand and ask your questions. So I will start, and I will go back to my previous question, because the core of the paper is based on risk and risk aversion, not only risk aversion from the household side, but also risk transmission and all of these things. But my question is, when you calibrate, when you change your calibration from your model, and to show us that there is an effect of the heterogeneity between the two calibrations you have, I'm wondering, is it realistic? When you say risk aversion is 2, okay, I don't think it is realistic. And I do think that there is some more playground around these values, around this calibration, by going deeper into the heterogeneities between
agents. Let me ask you a question.
Between agents, between agents and between countries. Yes.
Do you think risk aversion we should parameterize it higher or lower? When we take gamma is equal to 2.
I don't know. This is my next question about the empirical assessment of the parameters. But this is a theoretical paper, so it's up to you. You are in a linear, and you are in a linear. As far as I understood, just correct me if I'm wrong, but as you are in a linear framework, whatever you state, it's higher or lower, there is symmetry.
You're absolutely right. So first, what we've been doing in this paper is trying to derive some qualitative properties of optimal policies and whether we could make sense of fear of floating, exchange rate stabilization, and how inequality plays a role. We do not mean to very seriously calibrate the model because we would not really know how to do it. And also because the Cara normal structure is not in itself a very realistic structure. So it's mostly for qualitative results. Now, that being said, we calibrate the steady state such that the coefficient of absolute risk aversion is the same as the coefficient of relative risk aversion. And there are standard calibrations for so it's the same because the steady state consumption is 1. So the CR and the Cara coefficient are the same. So we use a standard CRRA coefficient to get to our result. This is why we're using the Egorov-Mukin calibration, which we think is also fairly standard. Now, if you have higher risk aversion, that's going to magnify the difference with rank. Well, I mean, it's a little subtle because
my question is not. Yeah,
because we're changing both
really to increase the levels.
Sorry.
Yeah. My question is not about increasing or decreasing all the levels, just playing with heterogeneities between agents, and to see if there is a gap between two agents or two countries in risk aversion, what it would imply in terms of optimal policy.
There is limited scope that we can do. It's not a two-country model. It's a small open economy model, and the rest of the world is taken as given. So we model the rest of the world as, just like in Auclair et al., it's a rank world. Okay, it's a representative agent world economy. And the small open economy is embedded in it, and it has idiosyncratic risk. So it's not exactly clear how we would be able to do what you suggest, which would be to have, asymmetry. I think it would make a lot of sense in a two-country model where where the other country will also face idiosyncratic
even between
risk.
two agents. Even between two agents.
Yeah, but again,
so you
with
have
two
the hand-to-mouth.
agents, but between two agents, it would change optimal monetary policy to the extent that the welfare of hand-to-mouth households would be affected. But
Yes.
for a given monetary policy, the dynamics of the model would not be affected because hand-to-mouth people they behave the same, whatever the degree of risk aversion that they have, right? Because
Okay. My point is that I think
they just consume their current
in
income.
risk aversion. Yeah, sure. But I just think that it would affect the
No, it would for sure. Like if they are really if they are really averse to intertemporal substitution, so they have high risk aversion, low intertemporal elasticity of substitution, then the planner would want to stabilize their consumption more, even more than it does here. I think it would go even it would reinforce the strengthen the results. It would go in the same
exactly.
Yeah.
I'm pretty sure of that.
Yeah, probably.
And I have also an idea where to put that even in the slide or in the So yes, so feel free to raise your hand. I have a lot of questions for Edouard, but I have the chance to be in contact with him, so I can ask him the question. So feel free to raise your hand if you have any question about the paper. Now we will take one question from, I'm not able to read your name, so from Vera Juan Camilo.
Hello, yeah. Do you hear me?
Hi.
Yeah.
Yes.
Okay, so I recently read this paper by Auclair et al., where they emphasize the role of this real income channel, as you said, and they also like have a little section on should the central bank stabilize the exchange rate when you face a capital flow shock, because, for example, if you depreciate, then that the role of expenditure switching elasticity relative to the real income channel will be less for realistic low short-term expenditure switching elasticities. So the real income channel will result in a contractionary depreciation. So I had the sense in your presentation that you said that these short-term elasticities from expenditure switching were higher than the Cole-Opsfeld parametrization, but I maybe I read it wrong in their paper, but they said that this ADA, this elasticity of substitution between home and foreign goods, was less than 1, and then they derived this result for the equivalence between a heterogeneous agent model and a rank model, which is this chi equals to 1. Yeah.
So there is a as you may know, there is a lot of disagreement in the literature about what the elasticities, the trade elasticities are. My understanding of the consensus is that they are higher than Cole-Opsfeld. Now it's true that in their paper they have contractionary depreciation for low elasticities. Okay, so they try to reconcile to argue that if you take a sufficiently short, of course it depends on the horizon, and if you take a sufficiently short run perspective, then elasticities are smaller in the short run than in the long run. But my understanding of the consensus, which is reflected in the paper by Egorov and Mukin that discussed this a little bit, is that these elasticities tend to be greater than what Cole-Opsfeld suggests. But it's not. Yeah, the evidence goes a little bit all over the place in this literature.
Okay, thank you very much. And another question I had is about the impact effect of macroeconomic shocks on the trade balance or on the current account. So with this Cole-Opsfeld calibration, the trade balance will remain like zero trade balance in response to any shock. So with
to
your baseline
productivity shock,
calibration,
and not necessarily to any shock, but to aggregate productivity shocks.
To aggregate productivity shocks, right?
Yeah.
So do you have this same result with your collapsal calibration and with
absolutely,
your different
absolutely.
elasticities?
So if I go back to so that's the if you look at panel G, the dashed red line is rank, and it says that trade is balanced because there is no net foreign assets, no change in net foreign assets, and HANK and RANK deliver the same. Okay.
Okay.
So so we generalize this result in a sense under some conditions, even though there is some heterogeneity between the agents. It's just that under this condition, the heterogeneity becomes immaterial for the optimal policy response.
Okay, so this can be read as the same benchmark that they derive for the equivalence between a representative.
Exactly. So that was the purpose. This was,
okay.
If I had shown you, directly, I mean, to you or to anyone or to ourselves when we started working on this project, if I had looked at those IRFs, like for example, these ones, I would just not have understood what's going on. Okay, because there is no way you can really understand, because there are so many things moving, so many moving pieces, that there is no way you can understand what's going on before you look closely in the eyes at the situation where not much happens, right? And then you can. So that's why we were really wedded to that benchmark. And this is also why Gali and Monacelli have, I mean, their paper as one of the most cited paper in international macro, and their paper is entirely about the open economy divine coincidence in rank, but for good reasons. That's how you understand how optimal monetary policy works.
Okay, thank you very much.
You're welcome.
It was a great presentation, great paper. Thank you very much.
Thank you, Juan, for your question. So if we have any additional question, please raise your hand. And feel free, I have two, maybe one or two other questions. So my second question is more, from a central banker perspective. And okay, so you say in a HANK model, we are able to maybe better manage foreign exchange rate volatility. This is the bottom line. How much? I mean, how much compared to a rank model, and how much, I mean, in absolute terms, also not only in relative terms, is it very, very important? But also, and this is maybe the second question, how much relative to the main objectives like inflation stabilization?
I mean, so there is one possible interpretation. So how much, as I said, so it's really a qualitative paper, and I don't want to make quantitative claims with this paper. But one minimal way in which you could interpret the results is the following. So suppose that you're in a situation where you occasionally want to intervene in the foreign exchange market to stabilize the currency, and the Bank of Israel has done that in the past. Many small open economies have done that. They do manage their float. It's not a free float. And the general question, so policymakers do that, central bankers do that. What is, how is it possible to make sense of that from a theoretical perspective? What are the underlying trade-offs that cause central banks to behave in the way they do? And the traditional literature stresses these terms of trade manipulation motive, that you can, sometimes it's better to stabilize the exchange rate, even if there is a cost in terms of domestic objectives. And the paper that we have, as I said, the minimal interpretation of it is that suppose there is inequality, is it going to change the direction of the manipulation that you want to implement? And we're saying no. It actually pushes towards even more exchange rate stabilization. So in the paper, we only have one policy tool, which is the exchange rate, which is the interest rate. We don't have an independent role for forex intervention, but in terms of objective, we arguing that essentially, the central banks are doing the right thing basically by aiming at a more stable exchange rate than what the rank model suggests.
Okay.
Does that answer your question? But I cannot tell you.
The first one. The second one is now about inflation. So I did not manage to assess the trade-off between the main objective, which is inflation stabilization or price stabilization, to be more precise, and exchange rate stabilization. Because I mean, saying exchange rate stabilization, the more you have inequality, the more you have to stabilize the markets, whatever, but especially exchange rate stabilization. That's nice. But in terms of when you say optimal monetary policy, the central bank has the main objective. The main objective, which is inflation, which is also impacted by exchange rate volatility.
Sure.
So now my question is what should the central, so we are a central bank, whatever, it could be the Bank of Canada, it could be another central bank. We have these two objectives. One is led by your paper and motivated by your paper. We have to stabilize exchange rate. One is more in the mandate. We have to mainly focus on stabilization of prices. How do we deal with these two objectives?
I mean,
there are more objectives, of course, but it's not in the model.
It is the case in the model that you want to stabilize domestic prices, right? So it's a model of flexible inflation targeting. It really is a model of flexible inflation targeting, where you want eventually, once the shock have died out, you want to revert to zero inflation. But you don't want necessarily to do it at every point in time, and you don't want to do it too aggressively in the short run when there is a potential conflict of interest, a conflict of objectives. And I think it depicts pretty much what central banks are doing. So in large economies, you can have these trade-offs between when you have a relative price shock, like an aggregate supply shock. You wanna stabilize. You want to stabilize inflation, but not at the cost of a major recession. So even though price stability is the main objective in the short run, you may be willing to let go. In small open economies, you may be willing to let go because of this. You want to alleviate the expenditure switching. You don't want to kill the domestic exporters. And that is captured by the Gali Monacelli, not the Gali Monacelli model, but by that model with the suitable trade elasticities. And we're saying, not only do you not want to kill, there are several reasons why you may not want to kill the exporters. One of the reasons is that if you kill the exporters, you're going to generate a lot of idiosyncratic earnings volatility in the economy. That's one way of putting it, right? It's not only that you're going to sell less on average, but you're going to generate more risk, more unemployment risk at home, and for that reason, you're going to manage the exchange rate actively, at least in the short run, even though in the longer run, price stability remains the primary objective.
Okay, thank you very much. If we have any additional questions, we are about 5 minutes to the end. We have 5 minutes, so if someone wants to ask a question, it's the moment. Please raise your hand. No, that's fine. Yes. Okay. So Edouard, thank you very much for this fantastic seminar.
You're welcome. Thank you again for the invitation.
With pleasure. It was very insightful and straight to the research questions we have in all small open economy central banks. And thank you again, and we hope to see you for your next policy-related paper.
Bye-bye. Thanks.